Welcome back to Talk Tickers.
Hey, everyone.
This is the premier earnings call summarization service for serious investors. If you're tuning into this deep dive, you're looking for the actual signal in the noise. You want to know what the numbers actually mean for your portfolio.
Exactly. We don't just read the press release. We tear it apart.
I'm your host, and I'm ready to get pretty deep into the weeds today because, well, we have a fascinating, incredibly messy, high-stakes situation on our hands.
Yeah, messy is definitely the word. I'm here to make sure we don't get entirely lost in those weeds, but we do need to look at the numbers, the overarching strategy, and the market's reaction.
Right, because we need to see if the story management is spinning actually aligns with the reality on the balance sheet.
And today, that balance sheet is screaming.
It is. We are putting a massive heavy hitter on the slab today. The ticker is PSKY, Paramount Skydance.
A literal case study in media consolidation.
Yeah.
And transformation. And frankly, quite a bit of corporate chaos.
So let's just set the scene for everyone right now. It is Thursday, February 26, 2026. The earnings call we're analyzing took place yesterday after hours. And look, I'm just going to rip the Band-Aid off right at the top of this deep dive. The market is feeling a little bit moody about this one.
Moody is a very polite way to put it. The stock closed today down 2.21%.
At $10.16.
Yeah, at 10.16. Now, in a vacuum, a 2% drop isn't a total meltdown. But you have to look at the broader macro context.
Right, the S&P was...
The S&P was basically flat today. So PSKY underperformed the broader market significantly.
And in the world of these high-stakes media mergers, that 2% drop feels heavy. It feels like Wall Street is crossing its arms, leaning back and giving the new leadership a highly skeptical look.
It's the classic show-me rating. You have to remember the timeline we're working with here. We're about 6 months into the quote-unquote new Paramount.
The Skydance team.
Right, the Skydance team. So David Elson and Jeff Shell, they took over a legacy battleship. That's what it was.
And their entire pitch to investors was that they were going to turn that battleship into a speedboat, a tech speedboat.
Exactly, a tech-enabled speedboat. But yesterday's call was a harsh reminder that before you can be a speedboat, you have to patch the massive holes in the hull of your battleship.
And as we saw in the release, there are a lot of holes. And they are very expensive to fix.
Extremely expensive.
So the vibe of the quarter, I just wrote down messy in my notes. We've got huge restructuring charges. We've got the legacy media networks dragging the anchor. But then we have this rocket fuel in the streaming division.
It feels like two totally different companies fighting for control of the steering wheel.
That's a great way to put it. Let's get right into the results snapshot. Let's talk about the number that probably made a few PMs spill their coffee this morning.
You're talking about the headline EPS miss.
Yeah. JEP earnings per share from continuing operations, it came in at negative 52 cents.
Which is, it's a number that just physically hurts to look at on a terminal.
Negative 52 cents. Let's pause and really let the listeners absorb that. Because the consensus on the street, Wall Street, was expecting negative 1 cent.
Basically flat.
Right. So a miss of 51 cents.
It's a massive delta. In percentage terms, it's astronomical.
It's not a miss. It's a complete whiff. So why was it so bad? Did they lose $500 million in a couch cushion?
No, nothing like that. And this is where you have to look past the headline gap number and understand the psychology of a brand new management team.
Kitchen sinking.
Exactly. This is a textbook kitchen sink quarter.
Let's explain that for the listeners who might not live and breathe accounting jargon, because it sounds domestic, but in finance, it's violent.
It is. So when a new executive team comes in, they want to set themselves up for future success, right?
Yeah.
They know the company they inherited has deep structural issues.
Bad contracts, redundant staff.
Right. Redundant employees, assets on the books that are wildly overvalued. Yeah. So the strategy is to take all the pain immediately.
Just flush it all out.
Flush it all out. You write down the bad assets, you pay for the massive corporate restructuring, you fire the overlapping executives, and pay out the heavy severance packages.
You exit those terrible legacy real estate leases and pay the termination fees.
Exactly. You take all of those costs and you shove them into one incredibly ugly quarter. You throw everything but the kitchen sink into the loss column.
Because it creates a strategic baseline. You make this quarter look absolutely terrible so that next year, your year-over-year comparisons look like a miracle turnaround.
Precisely. If you strip out those one-time restructuring costs and look at the adjusted numbers, the picture is completely different.
Adjusted EPS was negative 12 cents.
Right. Still a loss, but much closer to reality.
Yeah.
It's manageable.
Okay, so the JAP number is ugly by design. They're a cleaning house. Let's look at the top line. Revenue came in at $8.15 billion.
which was exactly in line with consensus. And it's actually up 1% year over year.
I mean, is up 1% actually good in this macro environment?
In legacy media, absolutely. Flat is the new up.
Because the headwinds are just brutal.
They are. Cable cord cutting is accelerating every single quarter. The advertising market for traditional linear TV is soft. If you are holding your ground while the floor is literally collapsing underneath you, you're doing well.
Survival is the first form of growth right now.
Exactly.
And I really want to highlight the adjusted OIBDA here. Operating income before depreciation and amortization, because this is our best proxy for actual cash flow from the operations.
It came in at $917 million.
Which is down 1% year over year, but the margins held steady at 11.3%.
Right. That's a key metric. Margins expanded by about 30 basis points year over year, actually. So despite all the chaos, the core engine of this business is still generating nearly $1 billion of operating income in a single quarter.
It's a cash machine.
It's a massive cash generation capability. People forget that.
And free cash flow came in at $198 million. That's up $56 million from last year. So they aren't burning the furniture to keep the lights on.
No, they're generating real cash.
But let's dig into the story of the two Paramounts here. Because it really is two distinct buckets. You have the good news bucket and the bad news bucket.
And they could not be more different.
Let's start with the good news. Because frankly, if you are long PSKY right now, this is the only thing keeping you sane. Streaming.
The direct-to-consumer segment, DTC, this was the absolute highlight of the call. Revenue was up 17%.
17% growth for a mature streamer in 2026 is impressive.
It is. The market is completely saturated. To grow double digits now, you have to take market share directly from someone else.
Right. You aren't finding new people who've never heard of streaming. You're convincing them to cancel Max or Disney and buy Paramount.
Exactly. But even more importantly than the top line growth, look at the bottom line for DTC. The adjusted OIBDA loss for streaming narrowed to negative $74 million.
That is an improvement of $19 million year over year.
They are basically inching right up to the line of profitability.
And for years, the dominant narrative around Paramount Plus was that it was a total money pit, a furnace where they just shoveled billions of dollars to try and chase Netflix.
Right. And now, narrowing that loss to under $100 million, it suggests they are very close to breaking even.
And the subscriber numbers completely back that up. They hit 79.2 million subs on Paramount Plus.
That's net adds of 5.9 million in the quarter.
Almost 6 million new paying accounts in 3 months. That is serious velocity.
It's faster growth than several of their peers right now.
But, and there's always a huge but, with this stock, we have to talk about the bad news bucket, the legacy business.
The anchor dragging the speedboat. TV media revenue was down 5%.
This is CBS, MTV, Nickelodeon, Comedy Central, the linear networks.
Right. And this is that secular decline we always talk about. Advertising dollars are fleeting. Carriage fees are dropping as people cut the cord. A 5% drop is fairly standard for the industry, but it still eats into everything else.
Every dollar you gain in streaming is fighting a massive headwind of a dollar lost in legacy linear.
And then you look at the studios segment. Film to entertainment, revenue down 19%.
Negative 19%. That number jumps off the page.
It was like a total crash.
So what happened there? Did they just release a string of absolute box office bombs?
No, it's a pure comparison issue. You have to look at the comp from exactly 1 year ago.
Ah, Q4 of the previous year.
Right. They had Mission Impossible, Dead Reckoning.
The Tom Cruise effect.
Exactly. It was a massive global tentpole. It drove huge theatrical revenue, huge home entertainment licensing.
Yeah.
This quarter, they didn't have a Tom Cruise movie.
So when you compare a quarter with Ethan Hunt to a quarter without him, the revenue is going to look like it fell off a cliff.
Movie revenue is inherently lumpy.
Yeah.
You just can't model a studio the same way you model a SaaS subscription business. It's hit-driven.
Okay, so we've got a mixed bag. Streaming is firing on all cylinders, legacy is melting, and the studio is just taking a breather. What are they guiding for next quarter?
Q1 2026 revenue guidance is 7.20 to 7.45 billion.
And the street was sitting right at 7.36. So the midpoint is exactly in line. No shocks there.
And for the full year 2026, they're calling for roughly 30 billion in revenue, which would be up 4% year over year.
So they actually expect to grow the top line this year, despite linear melting away.
That's the thesis. If the studio slate performs better and streaming keeps adding subs, The math works out to a positive 4%.
All right, let's go deeper. Let's really open up the engine room here and look at the streaming business. Because adding 5.9 million net subs in a saturated market doesn't happen by accident.
No, it takes a catalyst.
And looking at the transcript, there's a 3-letter acronym doing an incredible amount of heavy lifting for this company right now.
USC.
The Ultimate Fighting Championship.
David Ellison and Jeff Shell, they made a massive strategic bet on pivoting the platform toward owned sports, and combat sports specifically.
They gave us some hard data on UFC 324 on this call, which I frankly loved because streamers are usually so opaque about their viewership metric.
They were very explicit. UFC 324 reached approximately 7 million households across the U.S. and Latin America.
7 million households for a live streaming event.
They called it the largest exclusive live event in the history of the platform.
That rivals major network primetime numbers.
It absolutely does, and it completely validates their pivot. You have to understand the fundamental difference in media between renting sports rights and owning them.
Like renting the Olympics for 2 weeks versus owning the UFC?
Right. They are treating the UFC as a year-round customer acquisition funnel.
And a churn killer. That was a specific phrase management used that really stuck out to me, churn killer.
It's the most important dynamic in streaming right now.
Let's unpack that for the listeners. Why is the UFC specifically so good at stopping people from canceling their subscriptions? Is it just the demographics?
It's partly demographics, but it's mostly the calendar.
Yeah.
Think about the traditional CBS sports calendar. They are heavily reliant on the NFL.
The NFL is the absolute king of American media.
It is. It drives massive signups in September. Millions of people subscribe to Paramount Plus just to stream their local NFL games.
But what happens in February?
The Super Bowl ends, the confetti falls on the field, and millions of people immediately hit the unsubscribe button.
Because the utility of the app just went to zero for them until next fall.
Exactly. Then you have the Masters Golf Tournament in April. That brings in a very specific, affluent demographic. But then comes the summer.
The dead zone.
The summer has historically been a total dead zone for live sports on CBS. And that is exactly when churn the cancellation rate spikes.
Because if you're only paying for football, why are you letting them bill your credit card $12 a month in July?
You wouldn't. But the UFC fills that exact gap. It's a 12-month-a-year content machine. They have pay-per-views and fight nights constantly.
So by strategically placing big UFC events in that summer window, they create a bridge.
A bridge between the Super Bowl and the start of the next NFL season. It keeps that subscriber from leaving in March because they know there's a massive fight card coming in April or May.
It changes the consumer psychology from, I'll just rent this app for 5 months, to, I might as well just keep it active all year.
And it works. Plus, management specifically noted incredibly strong ad demand for combat sports.
Right, because it brings in that younger male demographic.
A demographic that advertisers are completely desperate to reach because those guys do not watch traditional cable anymore. You can't reach them on linear TV.
You usually have to go to YouTube or Twitch to find them. Getting them onto Paramount Plus is a huge win for their ad sales team. And they even mentioned Zuffa Boxing on the call.
Yeah, they are trying to own the entire vertical of combat sports.
It's a smart niche. It's a global, passionate fan base.
Now, staying on the streaming side, there was a really vital comment from the CFO, Dennis Ginelli.
About exiting the uneconomic hard bundles.
Yes. This is pure financial speak for prioritizing quality over quantity.
Let's clearly define what a hard bundle is for you listening right now, because you might actually be in one without realizing it.
A hard bundle is essentially a wholesale deal a streaming service makes with a distribution partner, usually a major telco or a mobile carrier.
Like when you sign up for a new T-Mobile plan and they say, hey, you get Paramount Plus included for free.
Or Walmart Plus, exactly. The end user gets the app, but Paramount is getting paid a steeply discounted wholesale rate by the partner.
We're talking pennies on the dollar compared to what a direct retail subscriber pays.
Right. It massively pumps up your total subscriber numbers, so marketing can run around saying we have 80 million subs. But the actual revenue per user, the ARPU, is terrible.
It's vanity growth, empty calories on the balance sheet.
Ginelli is saying they are now deliberately walking away from those contracts. He noted these bundles represented less than 2% of their total revenue, but they were artificially inflating the sub counts.
So by purging these deals, the headline subscriber growth might look a little slower.
But the revenue health is dramatically improving. The 79 million subs they reported today are substantially higher quality accounts than they had a year ago.
Because these are people who actively open their wallets to pay retail price.
And management is explicitly expecting an ARPU lift from this mix shift combined with recent price increases.
Better unit economics.
Exactly.
Okay, let's look at the other side of the streaming coin. Because it wasn't all rosy, Pluto TV.
The pioneer of the fast space, free ad-supported streaming television.
The statistics here were genuinely concerning to me. Non-Paramount Plus streaming revenue, which is mostly Pluto, was down 16%.
Down 16 in an environment where every single media executive is screaming that ad-supported streaming is the future.
Right. Netflix is pushing ads, Disney is pushing ads, Amazon forced everyone onto an ad tier. So why is Pluto shrinking by 16%?
It is a pure monetization failure, not a viewership failure. Management made a point to clarify that monthly active users, the actual engagement on Pluto, is up.
So people are actually tuning in?
They're watching more than ever. They're sitting there watching marathons of CSI and classic sitcoms. But Paramount's ad tech isn't effectively monetizing those eyeballs.
Why? Is it just a soft programmatic ad market?
Partially. But the root cause is their internal technology stack. Ellison identified this as a critical inefficiency. The new regime inherited a company operating on 3 completely separate, siloed tech stacks.
One for Paramount Plus, one for Pluto, maybe one for CBS News streaming.
Exactly. It's a logistical nightmare. It means your ad servers aren't talking to each other. You can't easily cross-sell inventory to an agency. You can't pool your user data to serve targeted ads.
So you're leaving money on the table every time an ad break happens.
They are heavily pushing toward what they call streaming convergence, unifying everything onto one modern tech stack.
So if they fix the plumbing, theoretically, they can actually extract the value from that massive Pluto audience.
That's the bet. If Pluto's monetization rate catches up to its actual viewership growth, that negative 16% flips to a positive number very fast.
Let's pivot now. We've analyzed the engine room. Let's look at the anchor. The legacy TV and studio segments. This is the cash cow that pays the dividend but keeps growth investors up at night.
PV media revenue down 5%. The melting ice cube.
But the key to this whole story is how they manage that melt.
Manage the melt. It's the reality of linear television right now.
You cannot reverse secular decline.
No, but you can aggressively cut your operating costs faster than your top-line revenue is falling. That's how you protect your profit margins.
And they explicitly stated they expect profit dollars to remain stable despite the revenue drops.
Because they are slashing overhead, consolidating overlapping departments across the different networks.
There's also a really interesting note about political advertising spend acting as a buffer in 2026.
Yes. 2026 is a massive midterm election cycle in the U.S. You have gubernatorial races, House, Senate.
And political action committees don't care about the secular decline of cable. They just need to buy local reach right now.
Exactly. It's a huge temporary windfall for the local broadcast stations that CBS owns. It masks the underlying decay of traditional auto and pharma advertising for a few quarters.
It buys them time to build the streaming lifeboat. Now, during the Q&A, the NFL rights came up. Obviously, losing the NFL would be an existential threat to CBS.
Jeff Shell sounded extremely confident about the upcoming renewal negotiations, though.
He did, and he specifically leaned into this concept of geofencing.
Geofencing is critical to understand here.
Let's explain it. Because to a layman, geofencing sounds like a security system for your dog.
In broadcast terms, geofencing means restricting a digital stream based on the user's physical GPS location or IP address.
So when I pull up Paramount Plus on Sunday to watch the NFL,
You don't just get a menu of every single game being played. You only get the specific game that is currently broadcasting on your local terrestrial CBS affiliate station.
right. If I'm sitting in Chicago, I'm watching the Bears game, I can't stream the Dolphins game unless it's the national broadcast.
Exactly. Now, why do they do this? Why not just give the subscriber everything? It's to protect the local affiliate owners, the station owners in Chicago, Dallas, Miami.
Because those affiliates pay CBS massive retransmission fees for exclusive territorial rights.
Precisely. If Paramount Plus just bypassed the local stations and offered every game nationally, the entire affiliate revenue model would completely collapse overnight. They would revolt.
So by geofencing the app, they're digitally recreating the legacy ecosystem.
They're protecting the reach argument.
Yeah.
The NFL's primary goal is maximum cultural reach. They want to be in every single living room.
And CBS can go to the league and say, look, Amazon can't reach a viewer in rural Kansas who relies on an antenna. We can.
It's a massive negotiating lever against the pure tech platforms.
It's a very delicate dance. They have to embrace streaming without accidentally assassinating the broadcast partners that generate their cash flow.
And geofencing is the software solution to that very complex business problem.
Let's talk about the studio. Filmed entertainment, we touched on the 19% drop because of the tough Mission Impossible comp. But David Ellison is a studio guy. He produced Top Gun Maverick.
Right, he's a highly successful film producer.
He is not going to just let the Paramount lot turn into a real estate play.
No, and this is where investors are waiting for the quote-unquote Skydance effect to materialize. But you have to pay attention to the lag time.
Ellison noted on the call that tentpole films have a rigid 2-year life cycle.
You greenlight a script today, you cast it, shoot it, spend 8 months on VFX, market it hits theaters in 2028. You cannot snap your fingers and fix a movie studio in 6 months.
So the films coming out in 2020
are almost entirely legacy projects greenlit by the previous Bob Bakish regime. Now, Skydance is trying to optimize it. They announced they are doubling the output from 8 theatrical releases to 16 in 2026.
16 releases. That is a massive ramp up in production volume.
They want more shots on goal. But the true Skydance-engineered slate, the massive IP-driven event films Ellison is known for, that won't actually hit the P&L until 2027.
They did mention Teenage Mutant Ninja Turtles as a bright spot.
Consumer products revenue for TMNT is up 5x compared to previous iterations of the franchise.
5 times. That shows a much sharper execution on IP monetization. It's not just about selling movie tickets anymore.
No, the theatrical release is just a marketing event for the merchandise, the video games, the lunchboxes, the apparel. If you spin the flywheel correctly, the movie doesn't even need to be a billion-dollar box office hit to generate massive corporate profit.
Okay, let's move to this section of the call that I think was frankly the most provocative. This is the deep dive into the real pivot. Ellison isn't just trying to run a better traditional media company.
He's trying to fundamentally alter what the company actually is.
The tech pivot. He used some highly specific, frankly nerdy language. He talked about transitioning the company from CPU pipelines to model-driven GPU pipelines.
It's fascinating language for an earnings call in this sector. You expect to hear about franchise synergies. You don't usually hear a media CEO talking about GPU infrastructure.
That's Silicon Valley terminology. Let's translate that for the audience. What exactly is a model-driven GPU pipeline in the context of Hollywood?
He's referencing the evolution of visual effects and animation. He explicitly mentioned the James Cameron digital domain era of the 90s. That was the CPU era.
Very labor-intensive.
Incredibly labor-intensive. It relies on thousands of artists working on massive server farms, rendering frames pixel by pixel over months. It's slow, and it costs a fortune.
And the GPU pipeline.
He is talking about leveraging generative AI, utilizing NVIDIA GPU clusters, and real-time game engine rendering. Using AI models to instantly generate complex background environments, lighting, and even character animation.
Why does this matter to a value investor? Is he just throwing out AI buzzwords to get a bump in the stock price?
It matters fundamentally because of the cost structure of content creation. If you transition a studio from a labor-heavy model paying hundreds of union VFX artists for a year to a compute-heavy model where AI generates base frames in seconds,
you lower the actual cost of production by an order of magnitude?
Exactly. He explicitly stated they plan to, quote, 10x the headcount of software engineers working on these specific tools.
He wants to build a proprietary tech company that happens to output entertainment. He wants to own the actual underlying tools of creation.
And if he actually executes that vision, his argument to Wall Street is that PSKY should no longer trade at a media multiple.
Right. Media stocks trade at like 6 to 10 times earnings. Because it's a low-margin, hit-driven business.
But tech companies trade at 20, 30 times earnings. Because software scales infinitely with high margins.
Yeah.
He's trying to force a massive multiple expansion.
That's the holy grail, but it is entirely unproven at a blockbuster scale.
Very unproven.
Speaking of incredibly ambitious and unproven bets, we have to address the massive elephant in the room, the M&A elephant.
Warner Brothers Discovery.
Management officially confirmed it on the call. They have submitted a revised formal bid to acquire WBD at $31 per share, all cash.
$31 a share in cash is a massive premium. It's a huge number.
And then complete silence. They refuse to take any further questions about it during the Q&A session.
which is standard legal procedure when you have an active, hostile, or semi-hostile bid outstanding. You negotiate in the boardroom, not on an earnings call. But the fact they confirm the exact price is a massive signal of intent.
But logically, why? Why does Paramount, a company actively bleeding cash in its legacy business and undergoing a massive restructuring, want to swallow WBD, which is drowning in its own mountain of debt?
Scale. It is a desperate existential race for scale.
The logic being that mid-sized media companies are fundamentally doomed.
Exactly. If you stay mid-sized, Netflix and Amazon will eventually crush you. But if you merge Max and Paramount Plus, suddenly you have a content library that genuinely rivals Netflix.
You'd have the largest theatrical studio market share in the world. You'd have massive news assets with CNN and CBS.
And an unstoppable sports portfolio.
Yeah.
The NFL, the NBA, the UFC, March Madness.
It becomes a utility, a must-have bundle that consumers mathematically cannot cancel without losing half of American pop culture.
Right. And management is projecting over $3 billion in operational synergies if the deal goes through.
Synergies usually being a polite word for firing thousands of duplicate middle managers and combining accounting departments.
Yes. But look at the market reaction. Down 2.2%. The street clearly hates the deal right now.
Because they are terrified of how Ellison is going to finance an all-cash bid of that magnitude.
The debt load required to buy WBD for cash would be astronomical. Paramount just proudly announced they paid down $300 million in debt this quarter to try and reach investment-grade status by 2027.
Buying Warner obliterates that deleveraging timeline completely.
Plus, the regulatory risk is off the charts. The FTC, under the current administration, is going to look at combining CBS, CNN, and 2 of the big 5 movie studios, and they're going to immediately sue to block it.
So the market is heavily discounting the stock because they fear a multi-year, incredibly expensive legal fight in Washington that will completely distract the Skydance team from actually fixing the core Paramount business.
It's a massive overhang on the valuation.
So bringing this all together into actionable investor context, the stock is down almost 6% over the last month.
In a flat market, it's an underperformer.
We have a severe valuation gap. The market is entirely ignoring the optimistic future, the narrowing streaming losses, the AI margin expansion, and intensely focusing on the ugly present, the linear decay in gap earnings misses.
It's a classic show-me story.
What is the catalyst? What should investors realistically be watching for over the next 3 to 6 months?
The next 2 quarters are make or break for the narrative. Can they actually cross the line into DTC profitability? Can they continue to add high ARPU subscribers while aggressively shutting off the hard bundles?
And obviously, the resolution of the WBD bid.
If that deal gets signed, the stock is going to move violently, either up on the synergy math or down on the debt fears. If the deal officially dies, then PSKY finally has to trade purely on its standalone fundamentals.
We also have to weigh the management credibility factor. The Ellison family, they are owner-operators.
That is the ultimate bull case. They are not hired gun CEOs hoping to collect a massive stock package and parachute out in 3 years. They use their own family wealth to buy control.
They have real skin in the game. If the stock goes to zero, they lose billions.
They are essentially asking Wall Street for patience. They're saying, give us until 2027 to fix the pipes.
And as we all know, Wall Street is famous for its immense patience.
Wall Street wants its returns yesterday.
Always. Okay, we have thoroughly analyzed the past. We have broken down the present. Now it is time to get a little bit reckless.
Oh boy, here we go.
It is time for our favorite segment, the part of the deep dive where we turn off the sensible fiduciary part of our brains and turn on the hedge fund cowboy part of our brains.
I have to put the massive disclaimer right here.
Yeah?
Listeners, what we are about to discuss is absolutely categorically not financial advice. Do not trade on this concept. This is entirely for educational and entertainment purposes.
Exactly. Do not leverage your retirement account based on this.
Huh?
But if you were a purely theoretical betting entity, I present to you a concept I'm calling the Skynet Studio Arbitrage.
The Skynet Studio Arbitrage. Okay. I am cautiously listening. What is the fundamental thesis here?
The thesis is that David Ellison is not actually trying to build a traditional movie studio.
Yeah.
He is stealthily building a generative AI content farm that just happens to legally own the intellectual property rights to Top Gun and SpongeBob.
Elaborate on that.
Think back to the massive Hollywood labor strikes a couple of years ago. The writers and the actors. What was the core existential fear they were striking over?
Artificial intelligence. The fear of being replaced by algorithms.
Exactly. Because AI structurally threatens the entire legacy labor model of the entertainment industry. Now, look at the language Ellison used yesterday. GPU pipelines, 10x engineering headcount.
Right.
He is telegraphing very loudly that he intends to rapidly replace traditional human-intensive production workflows with automated, model-driven ones.
Okay, I follow the logic.
The legacy studios, Disney, Universal, even Warner, they are massive, slow-moving cruise ships. They are locked into decades of union contracts. They employ tens of thousands of physical set builders, animators, grips.
They cannot pivot their cost structure quickly without causing a massive labor revolt.
Right. But Ellison is building a speedboat from scratch inside the shell of Paramount. If he successfully implements this model-driven generative production, their cost of goods sold, their COGS, drops by 40 to 50% overnight.
While Disney is still paying full union retail for every single frame of animation they render.
Exactly. Ellison produces a massive sci-fi blockbuster for $90 million. The exact same visual fidelity cost Disney $250 million to produce. PSKY's operating margins completely explode.
And when margins expand like that, the market is forced to re-rate the stock as a technology company rather than a legacy media company.
Precisely. It ceases to be valued like CBS and starts being valued like the Netflix of AI-generated IP. It commands a 25 or 30 times multiple.
So mechanically, how are you structuring this hypothetical trade?
You go long, but you have to give the thesis time to actually physically manifest. So you buy deep out-of-the-money LEPS, long-term equity anticipation securities.
We're talking long-dated call options.
Strike price $20. Expiration in January 2028. You are making a highly leveraged bet that by 2028, the tech pivot is mathematically proven in the quarterly margins, the Skydance 2027 slate has been incredibly profitable, and the stock price has essentially doubled.
That is exceptionally risky. The theta decay alone, you could easily lose 100% of the premium paid if the stock just trades sideways for 2 years.
But wait, there's a required hedge. Because we have that massive WBD merger risk hanging over the stock right now. If they actually announce they are buying Warner for $31 cash next month, the debt load terrifies the market. The stock likely completely tanks on the announcement before the synergy narrative takes over.
So how are you dynamically hedging that M&A volatility?
You pair your long-term luckiness with a short-term merger straddle. You buy short-dated puts right at the current money.
You're just betting on sheer volatility.
Right. If the merger is formally announced, the stock drops, the puts pay out massively on the dip, effectively covering the entire initial cost basis of your long-term leaps. If the merger falls apart, the volatility premium drains out of the puts, but you are still safely holding your purely isolated long-term AI margin expansion bet.
That is wild and mechanically plausible.
Yeah.
But it assumes Ellison can actually overcome the massive technical hurdles of AI generation at scale, which is a massive if.
We're bidding on the machines, the Skynet arbitrage.
Well, as we stated, do not try to execute that in your retail brokerage account tomorrow morning. But it certainly illustrates the extreme upside potential if the Ellison master plan is executed flawlessly.
All right, let's wrap this up. We have covered an immense amount of ground today.
We certainly have.
Let's give a quick rapid-fire recap for the listener who was maybe multitasking. The core results.
The results were decidedly mixed. A massive GAAP earnings miss due to kitchen sink restructuring, but top-line revenue was perfectly in line with street expectations.
The streaming business.
Growing rapidly and getting much closer to operational efficiency. The pivot to UFC and live combat sports is clearly working to suppress churn.
Legacy TV.
Dying a slow, secular death, but management is cutting costs fast enough to keep it highly profitable in the interim.
And the overarching strategy.
A radical pivot toward generative AI technology, paired with absolutely massive, highly risky M&A ambitions.
So a final thought for you to take away. Something we didn't explicitly cover, but is worth exploring. If Ellison's generative AI vision actually works, if a studio can create a blockbuster with a massive engineering team and zero traditional actors or physical sets, who is the ultimate loser in Hollywood?
The talent agencies.
Exactly. The massive agencies that extract 10% of the human labor costs. If human labor is abstracted away by GPU clusters, the entire agency business model collapses. Think about the ripple effects of that across the broader entertainment economy.
It's a terrifying thought for anyone working in traditional Hollywood representation right now.
The market fundamentally hates uncertainty. And PSKY just served up an absolute platter of it. Restructuring charges, hostile M&A bids, generative AI pivots. It is a massive amount of narrative to digest.
But you cannot ignore the core metrics. Almost 80 million streaming subscribers. The platform itself is undeniably growing.
If you believe that owned content is king, they certainly have the content.
But if you believe cash flow is king, they have a lot of work to do to prove they can generate it efficiently in the new era.
And as always, keep your position sizing responsible, keep your stops incredibly tight, and keep your eyes fixed on the ticker.
Thanks for joining us. We'll be right back here next quarter.
See you next time on Talk Tickers.